Hi, folks. Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory in Birmingham. Today is Tuesday, March 2nd, and we thought we'd come to you with a brief market update, just sort of let you know what is going on out there today. The S&P 500 is 3880, which is right around that 3900 level that we've been hanging out at since, well, really that we rallied up to since the beginning of the year. We've had a little bit of volatility over the past week and a half. So market was up probably actually closer to 4,000 on the S&P 500 before it dropped back down to about 3,800 last week. And then yesterday we had the single largest rally day since June, back up to 3,900. So a little bit of confusion as the market's really trying to sort out exactly what's going on with interest rates. For those of you who don't follow the 10-year Treasury, which is probably most of you, I hope most of you, 10-year Treasury rates have moved from basically about 0.5% in rough terms at the beginning of the year up to about 1.5% at the end of the year. So about a full 1 percentage point move. Is actually less than that if you want to get into the specific base points, but about 1% move on the 10-year Treasury. And those 10-year Treasury rates are rising, and that's causing a little bit of consternation for equity markets for two reasons. First, as interest rates rise, it drives a direct substitution effect from equity, asset classes into fixed income asset classes. There's now more yield, there's more return available in your fixed income securities, and so on the margin, people may rotate from their safer equities into some fixed income, and as people sell those safer equities, they offer better returns, and so it just cascade effects and impacts the market as there's that direct substitution effect. The second thing that happens is a valuation impact. So I'll spare you the gory details, but long story short, when we think about valuing future cash flows associated with something, we kind of have to discount them back to the present day. So if I ask you, what is the value of $100 that I'm going to give you a year from now, you may look at me and say, well, it's probably less than $100. I certainly would hope that you would say it's less than $100 that I had today. And the discount rate that I apply to sort of say exactly how much less than $100 is it worth is an interest rate. It's called a discount rate. And as we think about equities, which are really a promise of future cash flow streams, as interest rates go up, the discount rate that we use to value them, those future cash flow streams, also goes up, which means that they're worth a little bit less today than they were maybe a week or two ago. And so a lot of times, whether it's, we always talk about multiples in the stock industry, in the stock market as, price to earnings or EV to EBITDA or whatever valuation multiple you want to use. They're really just sort of poor man's shorthand for a discounted cash flow model, taking the cash flows that we expect that equity to generate and discounting them back over time. And so as interest rates go up, that discount rate goes up, and that discounted cash flow goes a little bit, the value of that discounted cash flow goes down. So the market's struggling a little bit with both of those things. And it's not uncommon for this to happen. We certainly saw this during the last time that we saw Treasury rates spike a couple of years back. We saw the equity markets take a couple weeks to sort of figure it out. The thing that I would encourage everybody to understand is that while interest rates are moving higher, they are generally moving higher due to things that are overall positive for our economy. So GDP is growing a little bit faster than we thought. We've got earnings that are coming in a little bit better than expected. We've got a stimulus package that's on its way. We've got virus activity that is lower than what people anticipated. And so the movement in the Treasury market is really, while it's sharp, it is really an indication of positive effects in the overall economy, which are generally on an underlying basis positive for equity asset classes as well. So A little bit of turmoil. I think that's why you've seen the market, bounce up, bounce down a little bit. But fundamentally, the reason why Treasury markets are moving higher is due to a positive thing, not a negative thing. And so, if that should hopefully help all of you sleep a little bit better at night. With that, as always, if there are any questions, please feel free to reach out to me or to your advisor. We look forward to talking to you again soon, and hope you have a great week.